Most people think a currency collapse starts when prices finally explode. That belief is wrong. The collapse starts earlier, when trust leaves the money before the public admits it. In Germany, the mark did not become absurd in a single week in 1923. The sequence had been building since 1914, when gold backing was abandoned, and by July 1922, prices had already risen about 700%. By November 1923, $1 bought 1 trillion marks. The headlines remembered the wheelbarrows. The real warning came long before the wheelbarrows appeared. Currency systems rarely die from surprise. They die in public, in stages, with warning signs that look manageable until the final stage arrives. The same pattern showed up in Weimar in 1923, in Argentina in 1989, and again in 2001, and in Venezuela after 2014. Different flags, same sequence. Every fiat collapse begins with a state problem, not a shopping problem. Governments overspend, promises outrun production, and the gap gets covered with debt, money creation, or both. Germany financed World War I with borrowing, then faced reparations after 1919 that had to be paid in hard currency. Imports were harder to buy. Raw materials were scarcer. Billions of marks stored during the war came back into circulation. That combination mattered, a larger money supply chasing fewer goods. Prices did not rise because merchants suddenly became greedy. Prices rose because the measuring stick itself was being damaged. Argentina followed a different script, but the same logic. After a decade of high inflation and stagnant output, the country fell into hyperinflation in 1989. In April 1991, the convertibility plan tried to restore confidence by fixing the peso at parity with the dollar. With 1 peso equal to 10,000 Australies, and central bank money creation tightly constrained. For a time, the peg looked like discipline. But pegs only survive when governments, banks, and political incentives remain consistent. By December 2001, Argentina had imposed a partial deposit freeze. In January 2002, convertibility was abandoned, the peso dropped sharply, and the banking crisis spread across the country. By the end of 2002, output had fallen 20% from the 1998 peak. Venezuela pushed the pattern into the modern era. After the 2014 oil price crash, a subsidy-heavy system, price controls and currency controls became harder to sustain. In July 2018, the IMF projected inflation would hit 1 million% by the end of that year, comparing the situation to Germany in 1923 and Zimbabwe in the late 2000s. That number sounded unbelievable. But here is what most people miss. Before a currency dies numerically, it dies behaviorally. People stop trusting it as a store of value first. Warning sign number 1 is fiscal disorder hidden behind official language. The public hears words like stimulus, support, emergency liquidity, reconstruction, or social protection. The state hears something else: permission to break monetary discipline. In Weimar Germany, printing accelerated because the government chose to create more money rather than fully confront the reparations burden and domestic weakness. In Argentina, repeated instability kept returning because nominal fixes could not outrun structural fragility. In Venezuela, critics pointed to unchecked money supply expansion alongside rigid controls. Different slogans, same result. The pattern is unmistakable. A government facing stress first tries to preserve appearances. Taxes are politically painful. Spending cuts are politically dangerous. Honest defaults are reputationally costly. Currency degradation looks easier. It starts quietly. The exchange rate weakens. Borrowing costs rise. Officials promise stability. Then larger denominations appear. In Germany, million-mark notes became billion-mark notes within 1923. In Venezuela, basic data itself became unreliable enough that the opposition-run legislature published inflation figures after the central bank stopped releasing essential statistics. When a system stops producing trustworthy prices, trustworthy data is usually not far behind. Fast forward to today. Modern economies do not need wheelbarrows to show monetary stress. They show it through chronic deficits, negative real returns, and a growing dependence on policy support. In the United States, M2 rose from roughly $15.4 trillion in early 2020 to above $21 trillion by 2022, while the Congressional Budget Office projected a 2025 federal deficit of $1.9 trillion and debt held by the public rising to 118% of GDP by 2035. That is not Weimar, but it is a reminder that scale matters, incentives matter, and money always reflects politics. Warning sign number 2 is the public fleeing the currency before the official collapse. This is where collapse becomes social, not just monetary. In Germany, prices rose so fast that a student recalled buying one cup of coffee for 5,000 marks and a second for 7,000 marks only moments later. That detail matters because it shows velocity. People spend faster when money loses value faster. Savings turn toxic. Salaries become time bombs. Pensioners become casualties. The middle class thinks in monthly budgets. Hyperinflation destroys monthly budgets first. Argentina revealed the same behavioral shift in a slower form. The BIS described a vicious circle in which exchange rate disruptions triggered defensive behavior, especially dollarization, preventing the peso from functioning as a reliable store of value. In 2011, demand for foreign currency rose substantially, and capital controls were tightened to reduce pressure in the foreign exchange market. That is the key signal. Once citizens prefer another unit of account, the domestic currency may still circulate, but it has already started losing its social role. It becomes mandatory money, not trusted money. Venezuela showed the final stage. When inflation expectations become anchored to exchange rate expectations, every depreciation can trigger another inflation shock. In Venezuela, the economy had been collapsing since 2014 after the oil price crash, and by 2018, the IMF's projected inflation rate of 1,000,000% placed the bolivar among the worst modern monetary failures. Human consequences arrive fast. Imported goods vanish. Inventories thin out. Professionals with stable careers discover that credentials do not protect purchasing power. Food, medicine, and fuel matter more than nominal salaries. Warning sign number 3 is the arrival of controls, freezes, and official coercion. When confidence disappears, governments often try to manage behavior instead of fixing causes. Argentina's December 2001 partial deposit freeze is the clearest example. Depositors did not suddenly become irrational. They were responding rationally to a system that no longer looked safe. The state answered by restricting access. Soon after, Argentina partially defaulted, convertibility ended in January 2002, and the peso fell sharply. A banking crisis followed. The lesson is brutal. When a currency weakens, bank access can weaken with it. The same logic appears in capital controls and price controls. Officials present them as temporary stabilizers. History treats them as warning flares. The BIS noted that exchange controls alone are not enough to restore nominal stability. Without a stronger external sector, deeper local capital markets, and positive real returns in local currency, controls simply trap more people inside a failing system. That is why the public response is so consistent across countries. First hedging, then hoarding, then exit. Exit can mean dollars, it can mean gold, it can mean inventory, farmland, tools, or migration. But it always means loss of faith. But here is what most people miss. Controls arrive after the first 2 warning signs, not before them. By the time withdrawals are limited or exchange access is blocked, the educational phase is over. The punishment phase has started. That is why historical literacy matters. A currency rarely announces its death cleanly. It announces inconvenience first, then delay, then paperwork, then limits, then exceptions for the well-connected. By that stage, the system is no longer operating on trust. It is operating on force. Warning sign number 4 is the destruction of paper certainty. This is where the public learns what was wealth and what was only denomination. Cash fails first. Long-duration local currency savings fail next. Fixed salaries lag. Bonds tied to a broken state lose credibility. What survives is usually simple, tangible, and scarce. First, hard assets with independent demand tend to hold social value better than local currency claims. In Germany, farmers who held food had leverage because goods mattered more than paper. In Argentina, those with access to dollars outside the fragile domestic banking framework had options when deposits were frozen. In every case, scarcity beat promise. Second, productive assets survive better than passive claims. A small farm, useful inventory, repair tools, or an exportable business skill can adapt when unit prices break down. Third, mobility matters. Families with foreign income, multiple jurisdictions, or access to outside banking rails usually preserve optionality. Fourth, low leverage matters more than high returns. Debt can look clever in a stable currency regime and become fatal in a distorted one. The winners in collapse are rarely the flashy speculators. They are usually the liquid, the cautious, the diversified, and the socially useful. Fast forward to today. The same signs can be watched without panic. 1. Monitor fiscal expansion relative to production. 2. Watch whether people increasingly prefer hard assets or foreign units of account over cash savings. 3. Pay attention to real yields after inflation, not headline rates. 4. Notice any drift toward controls, restrictions, or rules that make exiting the currency harder. Practical preparation does not require prophecy, it requires sobriety. Keep emergency liquidity, reduce dependency on any single institution. Build at least one resilient skill that can earn through volatility. Favor balance sheets over stories. Study the plumbing, not the slogans. None of that guarantees safety, but history suggests it improves odds. Every fiat currency collapse tends to show 4 warning signs before the final break: fiscal disorder, public flight from the currency, controls replacing confidence, and the destruction of paper certainty. Weimar showed the speed, Argentina showed the banking danger, Venezuela showed the terminal stage of lost trust. The names change, the sequence does not. The next chapter in this story is even more important. What the wealthy quietly move into before the public notices the regime has changed. Gold is only part of that answer. Land, cash flow, inventory, jurisdiction, and skills matter more than most headlines admit. If understanding the system matters more than merely participating in it, subscribe for the next study. History has the answers. I just show you where to look.